Welcome back to Skies Capital, where we view investing from 35,000 feet. Today, I wanted to look at the big oil through a very simple question. Can these companies profit quickly from the higher oil prices? And can they wrap up production quickly enough to really help the markets? Because those are two very different things. The setup here is that these companies can make money at oil prices much lower than where the crude is trading today. But even if the economics are attractive, new barrels don't show up overnight. These companies may benefit from the shock quickly through stronger prices and cash flows, but actually bring new production to the market still takes time. As you can see on the charts, all four majors had already been moving higher into the event. Before the latest escalation, each name was trading in a rising channel. Then, as the oil reacted to the supply shock, Chevron, Shell, BP broke out above those channels. Exxon is the one exception. It has not clearly broken out yet, but it looks like it is pressing right up against the upper trend line. So the chart message is pretty clear. The market is already starting to reward the majors most exposed to stronger cash flows if higher oil holds. When you look at the cost per barrel, Exxon and Chevron stand out the most. They have some of the lowest cost productions in the group, especially in their best shale positions. That means they do not need extremely high oil prices to make very attractive returns. Shell, BP can also benefit from the higher prices, but they are less compelling if you are looking for a strong, low cost, fast response supply story. This is the part investors need to keep in mind. Low cost barrels do not mean instant barrels. Even if these companies want to respond, there is still a process. They have to drill, complete, move the oil, process it, and get it to the markets. So even the fastest response still takes months, not days. That means big oil can help at the margins, but it cannot suddenly replace major oil supply disruptions overnight. That is why current production guidance matters more than just the oil spike itself. Exxon and Chevron already have growth plans in motion. So if prices stay elevated, they may be able to lean into those plans a little more. But the important point is this: most of the response is likely to be incremental, not a dynamic surge in production. So what is the probability of actually increasing production? My view is Exxon has the highest chance, Chevron close behind. BP, Shell are less likely to make a major near-time move. And even if they do increase production, it is probably something modest beyond the current plan, not a huge jump to suddenly fix the supply problem. So the first benefit here is likely stronger margins, stronger free cash flow, and not an immediate flood of new supply. And that is really the investor's takeaway. The market may keep rewarding these names not because they can solve the shortage right away, but because they can monetize it. If oil stays elevated, these companies can generate stronger earnings, stronger cash flow, and continue rewarding shareholders, even if production only rises gradually. So the next question is the one that I think matters most. If the oil stays higher for longer, which one of these majors is actually better stock to own? Next time, I'll break down Exxon, Chevron, Shell, and BP. Which one has the better chart? Which one has the better dividend defense? And which one is most upside? Crude oil stays elevated. Don't forget to follow, thumbs up Skies Capital, and let me know that in the comments which one of these oil stocks you would own here, if any. One parting thought: big oil can monetize the shock faster than it can cure it. Thanks for watching Skies Capital, where aviation meets investing.